How's everybody doing today? Is this on? Can you guys hear me? Can you hear me in the back? Hey, Bill Whitney, can you hear me? Got it, great. First off, I want to thank Organize Ohio, Chip Bromley, the Ohio Fair Lending Coalition for putting this on. But more importantly, looking at Mark Schweitzer and the Federal Reserve Bank and acknowledging what an asset this is, because as I travel across the country, the Federal Reserve Bank, the various offices now are really involved in community development. So we really need to rely, I think Tony Jones hit it, in terms of, or Marie, in terms of taking this data and really trying to make sure that we can make our cases. And the Federal Reserve Bank is great for that. So I know Mark just left, but if we could give the Federal Reserve Bank another round of applause. All right, my name is Lou Tisler. I'm the director of a housing counseling network for the National Community Reinvestment Coalition. It's a DC-based CRA organization that looks at banking and banking agreements and low to moderate income lending from a policy and advocacy perspective, from a small business perspective, from a housing perspective, and from a membership-based perspective. And so we have about 650 members across the country. In the Housing Counseling Network itself, we have about 60 across the country. So if you're not a member of NCRC yet, please, I need to get paid, so please be a member. If you are a member, thank you very much. Today's payday. So we looked at Mark's data, and he really talks about the, I think, the access, and it's not just access to capital, but it's access to the mortgages, access to applications, access on and on and on. And hopefully our panel will have some of the answers to the really depressing stuff that we saw from the low to moderate income borrowing perspective. And so in the past year and a half or so, we have signed with the panel here $62.3 billion of community benefit agreements. This is across their footprints that needs to be, that needs to be delivered to our communities in the next 5 years, 5 to 7 years. And so we are really lucky to have a panel of all the decision makers from that perspective. And I'd like to, their bios are in the program book, so I'm not going to go into how great they are, but they are great. So we have Bruce Murphy, the Executive Vice President of Key Bank, Barbara Anderson, who I'm going to look and go from right to left. So we have Barbara Anderson, who is the chair of the Greater Cleveland Reinvestment Coalition. We've got Stacy Glenn Short, who is the Senior Vice President for Fair and Responsible Banking from Huntington. And then also Stephanie Stewart-Young, who's the Senior Vice President and Regional Director of Community and Economic Development at Fifth Third Bank. So we have a great panel. And before we begin, I just want to start with a question to see a show of hands. How many people or organizations bank at Key Bank, Fifth Third, or Huntington? So if you could raise your hands. All right. So we've got a lot of customers out there. So we're hoping to have a great panel. So, you know, I think that Mark set the stage and had a great PowerPoint presentation. We're not going to get into PowerPoint. We're going to have a discussion. And so the PowerPoint that you see wrapping around here every 5 seconds or so, if I actually did it right, will show you what the commitments are to each bank. And so as we discuss these aspects, we're not really going to delve into a PowerPoint presentation, but a discussion. And so one of the things that I really would like to start out with is for Barbara to discuss the role of the Greater Community Reinvestment Coalition, which was the impetus of bringing together people to sit down and talk about these community benefits agreements. So when we were going through the Key Bank one, and I was at NHS of Greater Cleveland at that time, we met during Christmas break and talking about herding some committed people on Christmas break to meet at the tower of Key Bank on a very frozen, cold day. We really had the community there to talk about it because it was that important. And so, Barbara, if you could set the stage from the GCRC perspective.
Certainly. First of all, let me just say that none of that $63.2 million had anything to do with me. It did not come out of my banking account. So let's look at them.
If you could move closer to the microphone, please.
Am I doing something wrong? Okay, how's that? Is that better? Okay. But what I kind of look at when I'm thinking about an organization and I'm hearing about it is what do they do and why? Why is that organization even necessary? Because most of the times we think that things are certainly covered by the organizations that are already operating in the neighborhood. GCRC is trying to service and address an underserved or unserved market. The city of Cleveland, and you're aware of this, and its inner ring suburbs was hard hit by the financial crisis of the late 2000s. Some of us even recognized it in the late 1990s. Property values dropped substantially in many, many areas, and many suburbs have not seen property values rebound to pre-crisis levels. Also, following the financial crisis, there was a tightening in the credit market. As a result, many households were not able to obtain mortgage financing through government-sponsored programs such as FHA or VA, and sometimes that's the only way they could get any financing at all. While these products are attractive and readily available tools for purchase and refinance, the mortgages themselves often require little or no equity, that's in the case of a refinance loan, and little or no down payment in the case of a purchase. GCRC, the Greater Cleveland Reinvestment Coalition, is a voluntary coalition of more than 60 community stakeholders who came together to form and create a vision for on-the-ground or local execution of the 2017 CBA, Community Benefits Agreement. So we started off as a part of NCRC and still are totally supportive of what they do and their efforts. We came together to understand what it is that the CBA could offer each and every one of our communities and how would we best access to make sure that the monies that was designated for the community actually reach the community on a ground level. We represent government and nonprofit agencies in the city of Cleveland and the suburbs of Cuyahoga County. So we are trying to make sure that across the level, that we level the playing field, and that across that level that each of us in our communities, in our neighborhoods, make sure that each person who is able to actually receives a loan that's responsible and a loan that they can pay back. We address availability of purchase money, first mortgage products in amounts less than $50,000. As you know, a lot of our homes in the communities where people actually live, those are the loans that are below $50,000. And that's sometimes an amount that many banks have turned a blind eye to because of the cost of financing those loans. We would like to see something that addressed the loans of less than $50,000. The lack of mortgage investment in creditworthy households, as you saw in the dated information that was given to us earlier today from the Federal Reserve Bank in LMI census tracts, making sure that those creditworthy people are also addressed. And the private smaller investor and owner-occupied rehabilitation investment due to the appraisal gap. And we've seen that over and over again where your houses may be appraised at one level, but the actual value is another level. So there's a huge appraisal gap between what it's worth and what it's been appraised for. So we're looking at those different areas for equity products to credit-worthy household with loan-to-value ratios in excess of 80%. GCRC comes together as a huge coalition of over 60 different groups. All members of GCRC have the capacity to assist in these identified areas that I've just mentioned. We build on our collection of strengths by supporting, scaling, and replicating programs that are working in our community even today. We're already on the ground, already working in the community, have face-to-face access with people who are having problems with their loans or with their homes, needing them to be rehabbed, needing them to sometimes even small rehab loans, not always a roof, maybe to fix a porch or something like that, but also for our seniors who are struggling to remain in their homes. We believe that it's possible to work together to craft products and solutions that work in our neighborhoods and will lead to favorable economic gains for the banks. We're not asking the banks to take an unworthy or unwise loss, but we are asking them to support with the finances that they have available to them to support our communities. We're excited about our collaboration and excited about the opportunities that we can offer to the communities as we continue to collaborate with different banks and make sure that the returns come to our community. GCRC stands ready and able to serve and to collaborate. Thank you.
All right. Well, thank you, Barbara. And so now I want to get into that conversation. How are we going to spread the $62.3 billion? And so just to set the table, one, I'll take any checks, is that we're going to have just a brief discussion of why they came about from each institution. Then we're going to talk about mortgage product, or the mortgage realm, the small business realm, the community investment, philanthropy, and then really give it a free-for-all from the panelists. So keep in mind that's the direction we're going. And so if we could start, if all the panelists could give just a brief history of the reasons behind your respective CBAs, the process involved in their creation, and maybe a 3,000 or 30,000-foot perspective on community outcomes, footprints, impact, et cetera. If we can start with you, Mr. Murphy.
Well, first of all, let me say I appreciate the opportunity to talk about something that is, in fact, very important to me personally as well as to our company. Investing in communities is, in fact, a value that shows up in many different ways, and frankly, none more important than developing a community benefits plan. When we did this acquisition of First Niagara, the first thing we really did was really begin to, Beth Mooney, the CEO, went into the communities. Why did she go into the communities? She wanted the communities to get a sense of who we were, especially communities that they were not familiar with us, went into those communities to begin to understand what we value, how we in fact demonstrate that value, and how we in fact show up. The second thing we did is that we had community conversations. We had community conversations in every one of our markets, and community conversations is a guiding principle of how we in fact think about how we operate on an ongoing basis. Our 8 consecutive outstandings is built on a foundation of direct engagement. It's built on a foundation of measurement and reporting, and it's built on a foundation of really beginning to understand how you get community insight that guides the way, in fact, the way in which you, in fact, operate your organization. The community benefits plan, we found and believe that it is the most outward-facing tool to demonstrate your commitment. You know, you can talk about commitment in lots of different ways, but when you show up definitively that says what you are going to do, and oh, by the way, when you say you're going to do it Beth Mooney would say, you're not going to make a commitment that you're not going to meet. And so when you say you're going to do X, you are going to do X. She used to be an ex-CFO, and every now and then the CFO comes out in her. And if you know anything about a CFO can be very aggressive about meeting goals and setting goals. So our interest in building the community benefits plan was really about community engagement, getting community insight. You can build goals, you can say you're going to do X, Y, Z, but if you don't have community insight, then all you have are numbers that you may or may not achieve. And so not only is it on the front end that we have community insight, with our advisory councils, with the way that we have continual outreach and people on the ground throughout our footprint, ultimately we're after continual feedback. And we clearly report are challenged. Sometimes that challenge is a little ouchy. That's good. I'm not afraid of that because you can't grow unless you, in fact, are both transparent and are willing to hear things that are not comfortable. And I'm fine. I don't like it. Sometimes my head is bloodied but unbowed, but at the end of the day, it's the right thing to do if you're going to create a sustainable outcome in our community. So, I could go on. So I'll stop here. I will just leave you with 3 things. Community engagement is important. Reporting and transparency is critical. And ultimately, demonstrating that you have, in fact, delivered through community insight the things that the community needs to have. We won't always agree on all those pieces and parts, but in the main, I think we will be collectively satisfied with where we end up.
Thank you, Bruce. Stacy, quick introduction on the CBAs?
Sure. Oops. Is this on?
Yes.
Okay. Just a couple things. One of the things that we do as a part of looking at an acquisition is first and foremost looking at the blend of the 2 organizations from a community perspective. And how will those 2 organizations enhance each other, right? Is there products and programs we can take from one and move those out into other markets that we haven't covered previously? So that was first and foremost our first step in this process. As part of that, pretty much the night that we decided to move forward with the acquisition of First Merit, I reached out to John Taylor. And I said, we've put together a plan as part of our due diligence, and I'd really like the opportunity to run through it with you and see what your thoughts are and what we can do better. And when Steve Steiner, our CEO, and myself met with him, he highly encouraged us to move forward with the community meetings. And that was something that we would not have done probably traditionally because we felt we were pretty engaged with our communities. But we did that, and we learned a lot. Where we felt we had very strong products and programs and people weren't using them, what we learned is that people didn't even know about them. And so, and Chip chuckles because he was in one of those meetings where we learned that, and it was really very eye-opening to us. So I think from that perspective, having those conversations really enhance everything that we're trying to do and really work on. It also sparked internal conversation because not only did I attend the community meetings, we also had all of our senior product executives attend the meetings as well as our CEO. So they were hearing direct feedback from all of you where we had some shortcomings. And so it really sparked a very strong internal conversation about how we would take this feedback that we were gifted with and really put it to use and improve the products and programs that we have. So I think, really hearing from all of you and having your lens and view on what we were doing was vitally important to us ultimately developing our plan. So our commitment actually covers our entire combined footprint. So we increased our footprint by 2 states, and then in the states we're already in some of the territories. So at Huntington, we actually track 104 markets. So to Bruce's point, we're all monitoring and making certain that we are following through on our commitments. So we have 104 markets that we are currently digging into, trying to better understand the needs of the communities, and then take that information that we learned from all of you and then put it to our best uses. So I really feel that having the community conversations really opened sort of a very strong line of communication for all of us to work to build impactful programs and processes and products.
Thank you, Stacy. Stephanie?
Good morning, everyone. So the question was why, and putting the customer and also the community at the heart of everything we do is at the core of the reason why we came up with this community benefit agreement. We went through, and we are Fifth Third Bank, we went through a series of leadership changes within our organization over the last couple of years, most notably our CEO. We got a new CEO, Greg Carmichael. He's from Ohio, very passionate about community, And he wants to be a part of his legacy. He wants Fifth Third's footprint and our impact in the community to be a strong part of his legacy. And as a result, as an institution, we have shifted our focus from getting being okay with a satisfactory to saying outstanding is where we want to be. So number one, it's at the core of who we want to be. It's at the core of who our leadership wants us to be from a community perspective, and so that's why we did it. Another thing that I'll put out there as well. You heard mergers and acquisitions from Stacy and Bruce around their reasoning. We went through a CRA exam, and we received a satisfactory around our core CRA performance. We were actually only a half a point away from an outstanding. So very, very strong CRA performance, but not outstanding. And we received some findings that were non-CRA related that impacted our rating and provided us with a downgrade from that satisfactory. And so this community benefits agreement allows us to not ever be in that situation again. So we want to make sure that we're at the table, that we're listening to community partners, and that we do show up. And this community agreement allows us to make sure that we're holding ourselves accountable to our communities internally, and that our line of businesses and everybody's on the same page within our organization around making sure that we achieve those results. Around process, what I will say is very similar to Bruce and Stacy. We came up with our commitment. We reached out to NCRC to get their engagement in the process. We went through a series of listening sessions, which was extremely valuable. We appreciate, there's no way we can achieve this community commitment without community partnership. And so that was extremely valuable in our process of enhancing our commitment. We took those learnings back internally within our organization and worked with each of the executives. And by the way, one thing I'll mention, in every single listening session, the head of our consumer bank was in every single listening session. So it wasn't just the Community and Economic Development Department. We had the head of the consumer bank and our CEO that sat in the listening sessions throughout our entire footprint. And so that was extremely helpful. I think we shared through our Community and Economic Development Division, where the opportunities were, because we do regular community needs assessments, pretty engaged with our community. But it was nice for our executive team to hear that firsthand from our community partners in those meetings. And we took all of that information and enhanced our commitment to a $30 billion commitment, one of the largest commitments out of any regional bank. And we feel really, really good that we got the right level of engagement from all of our leadership internally to make sure that we were stretching ourselves to do the most that we could do for our communities. And so I am pleased to say within this $30 billion commitment over the 5 years, $11 billion of that is in mortgage lending. You can see the slide flipping there, $10 billion in small business lending, $8 billion in community development loans, and community development loans are really a subset of commercial loans that have a specific community development purpose around affordable housing, economic development, revitalization and stabilization of low and moderate income communities, and services to LMI. So $8 billion in that. $1 billion in CDC investments, and another $93 million in charitable donations. To date, and when I say to date, we started this commitment in January of 2016. As of June 2017, commitment to date, we're at $12 billion of this commitment that we've made. So we're about 40% on target to hit our commitment. We're actually ahead of pace, so we feel really good about the progress that we've made. $3.6 billion of that is right here in the state of Ohio. So we've made significant improvement and investment in our communities through mainly access to capital in the mortgage, small business, and community development space, but definitely from a philanthropic perspective as well. So feel really good about the progress that we made, and look forward to your continued partnership as we continue down this path throughout the rest of the 5 years.
All right, thank you, Stephanie. So when you're talking about $62.3 billion, you kind of have to set the table. So, there we go. You know why they did it, what their commitment is, what their corporate culture is in terms of making that happen. So now we're going to delve into how we're going to divide that up. And so we're going to talk about mortgage lending, small business lending, CD investment, and philanthropy. And now, as we talk, and you have three very good friends here, they're friendly with each other, but you have to realize that they're also in a competitive business environment. So are we going to hear proprietary products or inner strategic planning? Probably not. So we really can't push from that perspective, or we get the Federal Reserve comments that, it's their opinion, we can't talk about it, our lawyer said. But we're really going to, with each person that we go to, I will state what their commitment was in mortgage lending, small business, CD investment, and philanthropy, and then each will be able to talk about that. So, Stacy, we're going to start with you with the mortgage lending aspect, $5.7 billion over the next 5 years.
Sure. So I think, as I alluded to a little bit earlier, we felt we had a very strong mortgage product, and actually had been surprised for many years that it wasn't used more. And really, as we were having the community conversations, we found out it was because no one knew we even had it. So I think our probably strongest investment in this space, Lou, is that what we learned is we needed more people out in the community really talking about what we had to offer. And so that's where we've really made an investment in this particular area, is making certain we have more people out there working with all the organizations to partner and get that product out for everyone to use.
Thank you. Stephanie, you had stolen some of my thunder, $11 billion over 5 years, but that's a big number.
Yeah.
So if you could chime in a little bit more on the mortgage lending perspective.
So before I get to the mortgage lending, I just kind of want to set the stage around how we're going to ensure how we ensure accountability around making sure that we hit our numbers from a commitment perspective. We built a structure internally. We call it our CRA Commitment Core Team, that's chaired by our head of our consumer bank and also our chief corporate social responsibility and reputation executive. And all line of business leaders are part of that core team, as well as our CED, Community and Economic Development Leadership. And so we meet on a monthly basis. We have dashboards, and we're consistently talking about this commitment from the top of the house. And that's a very different for us within our organization. And so just wanted to kind of throw that out. In addition to that, we created core CRA commitment core work streams on every single piece of the commitment. So we've got a work stream on mortgage. We've got a work stream for the small business space. So we have a work stream that's led by one of our community and economic development leaders, as well as that line of business leader. And we've got other key partners internally within the organization that are on those work streams. And those groups are meeting at minimum monthly. Many of them are meeting biweekly to discuss progress, strategy, product, what do we need to do to make sure that we're showing up in the best way that we can show up in our communities. And so just wanted to set the stage around kind of how we've built our structure to make sure that we have elevated visibility around the commitment internally in the organization, but also accountability around it as well. So as it relates to mortgage, what I will tell you, three things that I think really allow us to make sure that we're going to accomplish the $11 billion. We've looked at staffing, we've looked at product, and also community engagement in the mortgage space. And so a couple things that we've done differently from a staffing perspective. We hired a dedicated CRA mortgage manager, which is different. That was a position that we did not have previously. Actually, the person who got the role was previously reporting to me. So I was glad to see that promotion take place. So she's a point person on the mortgage side of the house, and from a CRA perspective, working with the line around product, around what we need to do in the affordable space. So that's a great add that we added as a result of this commitment. In addition to that, we have hired dedicated unit mortgage loan officers and sales coaches for the affordable space. We've also analyzed our MLO placement in LMI areas to make sure that we look and represent, look like and represent the communities that we're serving. And so that's very different. We make sure that we keep that forefront and that we're being conscious about that. And then we also revised our MLO compensation plan. On the product side, We have rolled out our first time ever our own bank-funded down payment assistance program, which is huge. We never had our own down payment assistance program, so we're able to provide DPA in the amount of 3% or up to $3,600. So that's a really nice add that our mortgage loan officers are able to offer to customers and clients in low-income census tracts and that are low-income borrowers. We also introduced or rolled out what we call a community reinvestment mortgage special, specifically targeted to low-income tracts and low-income borrowers, where we're actually waiving all of the fees associated with their mortgages. So that's a new initiative we rolled out. We do have, and I heard Barbara mention this, we do have a no minimum loan amount for mortgages, which is something that we're proud of at the bank. So that is something that we do as well. And we continue to look at our program offerings. We're actually getting a new mortgage loan system that's actually going to be rolled out in 2018 that will allow us to gain reentry into some of our bond programs, first-time homebuyer bond programs throughout our markets, but then also explore other potential portfolio types of products once that new system is on board. So a lot of positive momentum kind of on the product side. And then from a community partnership perspective, to support affordable housing and home ownership, we've really realigned our philanthropic focus, and affordable housing development with a specific focus in home ownership. Home buyer education is a big focus area of our philanthropic strategy. And so, and that's to support the nonprofits and community development agencies that are doing great work in this space. And so we've really realigned our philanthropic focus to make sure that this is one of the core areas that we help to support fund community groups in doing this work. And one other thing that I'll mention, we work extensively with nonprofit agencies, homebuyer education providers, and we've been doing a series of educational sessions throughout the course of the year in partnership with Freddie Mac to make sure we're reaching out to realtors and community partners. We've educated 400 plus community partners throughout the course of the year with those educational sessions, and so just continuing to do things to outreach. I heard Chip mention how are we marketing, how are we going out there, and we're being very proactive around our external outreach around the work that we want, where we want to play, and how we want to show up in our markets.
Great, thank you. Bruce? Key Bank, $5 billion, 5 years?
$5 billion, 5 years. Many of you know that Key never had a mortgage company. We had a mortgage product, but never had a mortgage company. And with the acquisition of First Niagara, we now have a mortgage company. What's relevant about that? Because now we can manage end to end. We manage servicing. We can really manage the whole process in the mortgage space. The $5 billion for us is a significant target. And to meet that target, there are several things we are doing and in the process of managing. We've hired over 40 MLOs focused in the space. Clearly,
And Bruce, before you go on, if I could just say MLO, mortgage loan officer. So.
mortgage loan officers, yes. So we will try not to use bank acronyms
Yes,
as we're all
sorry.
used to using. I'll give you a scorecard here in a minute, and you can figure out what we talk about sometimes. But the point is, in those hires, we're looking at diversity, we're looking at location, we're looking at relationship with the realtor community, the realtist community. We are actively engaged in the leveraging of our capability. We too also have a new mortgage system, a state-of-the-art mortgage system, which we're rolling out. The strategy that we now have in the mortgage space is a new strategy. Because again, as I said, we didn't have a mortgage company. We now do. We have hired some very talented people. We have two regional managers who focus on the low to moderate income space. One, given our footprint, which is Maine to Alaska, we have branches in the Aleutian Islands. So sometimes we don't think about I just got off of a plane from Seattle. in Portland, Oregon, in Salt Lake City, Utah, in Boise, Idaho. We have a footprint that's very unique in that regard. So we have people who are on the ground, focused specifically in this particular space. Our product, we've always had a what I think is a very strong product in this space. Our community loan product in this space has always been a product that both realtors and members in the community find to be a very competitive product. We have a series of trainings that are going through from our branch system to our frontline MLOs that really include intensively what are we doing in the LMI space. As it relates to measurement, our overall measurement, not just in the mortgage space, but we meet with our board quarterly to talk about our progress. We meet with our executive leadership team, Beth and her direct reports, on a monthly basis. These numbers are not only top of mind, but they are embedded in the leadership's annual review. And so this is, when I said that Beth is serious about ensuring that we deliver, when you hold people accountable directly in what they ultimately do every day, that's how you hold people accountable. My particular team in corporate responsibility, the Stephanie Turners of the world, the Adrian Bruces of the world, we have those folks alongside of our line of business teams to execute and deliver. And so we've got this overlapping set of eyes to ensure that both in terms of reporting and measurement and then review, that is how we in fact will in fact achieve the $5 billion that we're talking about.
Thanks, Bruce. Now we're going to move to small business lending. And so if we look into our communities and look at what the economic driving engine is, I don't think that there's 50 Amazons out there to spread around and give away the farm and tax credits and things along those lines. But if we're going to build up our economy from a small business perspective, we need access to capital. And so small business lending is a very important part of the community benefits agreements. So if we could start with Stephanie, $2.5 billion over 5 years.
Yes. So a couple key things, once again, staffing. Something new that we did at Fifth Third, we created a new position called our Small Business Community Lenders. We've hired 7 small business community lenders across our corp, 3 right here in Ohio, 1 based in Cleveland, 1 based in Columbus, and 1 based in Cincinnati. That's one of the ways that we're going to achieve this. Those small business community lenders are aligned with our low and moderate income census tract financial centers. So they're specifically doing outreach, calling efforts in targeted areas to make sure that they're providing access to those communities. We've made sure that those individuals that we're hiring are the right fit for those communities and the right fit for our community-based organizations that they're also partnering with. So, so that's a big initiative, or I shouldn't say initiative, a new do different that we established this year in our bank. In addition to that, we had some major investments in 2017 in technology. We got a new application and underwriting platform, which is really leading towards faster response times, less customer information being needed, enhanced transparency, some digital channels to apply, as well as pre-approved offers. So we've really invested in technology to make sure that we could do the work that we need to do in this space. In addition to that, we have enhanced our products and credit policies to provide more customers the funding they need while managing, of course, appropriate risk. A couple key things that I'll highlight here. We lowered our credit requirements for SBA Express product. We lowered our score requirement for established customer relationships, or SBA. We enhanced our SBA loan program and reduced the time for underwriting and fulfillment. We've updated our underwriting guidelines for our business line of credit to improve approval rates and remove barriers to close. And we reduced personal guarantee requirements for businesses with multiple owners. So, and we continue to roll out enhancements and other items that are instrumental in helping to make sure that we're able to provide access to capital to small businesses. Last component, again, is community partnerships. So we've aligned our philanthropic focus where small business entrepreneurship, specifically micro-lending, and growth of small businesses is a big core and focus of how we're using our philanthropic dollars. We've also worked with some key community partners in the small business space, Community Reinvestment Fund. We are creating or just created a cluster program focused on engaging local CDFIs. And so that's a new initiative that we're in the process of rolling out. $5 million will be deployed through Community Reinvestment Fund to local CDFIs so that they can then lend to small businesses in each of our local respective markets. I don't know if everybody here might know Economic and Community Development Institute. We did a $2 million investment in their micro loan fund. We have another partnership with Axion, which is a agency based out of Illinois that will be providing will be providing small business loans through their loan fund throughout Ohio, Illinois, Michigan, Indiana, and Florida for us. So this allows us to not only do direct lending, but also work through some of our community partners to reach and provide access to capital to some small businesses, specifically micro lending, et cetera. So doing a lot of work in this space, and all of these partnerships are contribute to our ability to hit these numbers.
Great, thanks, Stephanie. Bruce, 2.5 billion small business over 5 years.
2.5 billion over 5 years. This is a space where, the critical element of small business for us is looking at partners who can help deliver these opportunities. As many of you know, we invested $24 million in Jumpstart. That $24 million Jumpstart investment is really about creating entrepreneurs, minority and women-owned businesses, and looking at ways in which we can provide also technical assistance to those early stage, emerging stage companies who really can begin to scale up. And so we're using our philanthropic dollars as a way to begin to jumpstart, if you will, jumpstart the work that we're doing in the small business space. With regard to the actual other small business delivery, we're adding 40 new relationship managers on the ground, focused again in driving small business throughout the marketplace. And lastly, I would tell you that the new leadership that we've brought in, we've hired a new leader to run that business. That leader brings a wealth of not only technical experience, but also learning how to leverage the technologies that the small business owners are now expecting now to see. So technology is in fact one of the important ways that small businesses are deciding that they are going to grow, and we're down a path to look at ways that we can begin to deliver those kind of technologies that will allow them to scale up their individual businesses.
Thanks, Bruce. Stacy, small business, 6.6 billion over 5 years.
Sure. So Huntington happens to be the #2 SBA lender in the country, and that's lending only in, at that time, our 5-state footprint. So if you take all of the SBA lending that happens across the country, we're #2 in all that. So for us, it was really trying to figure out how do we take a model where in a city it's working really well and deploy what we're doing there and moving it to a city where it's not doing as well. So we've spent a lot of time focusing on really seeing how we're doing well in a particular community, whether it's partnerships through outreach, whether it's having, people inside the branches that really understand the products and programs. I think that's one thing that we do a little bit differently at Huntington is our branch managers can take any small business application up to $2 million. So you don't need a special small business lender to come meet with you. You can handle that right in any branch. So I think that's one of our differentiators. It was working well in some places and not well in others. So we have spent quite a bit of time at analyzing who our employees and colleagues are in those markets, what the partnerships and relationships look like, and how one market is working better than another. So we, again, in this space have added additional community small business lenders to really push that outreach a little bit further into the market.
Great, thanks, Stacy. So we have about 18 more minutes, so we're going to go into a lightning round
Okay.
to try to get to the end and still have time for questions. So for the panel, we're going to go to philanthropy. And so in terms of talking about philanthropy, we're looking between these agreements about $320 million between the three institutions. So, and Stacy, I want to go back to you in terms of talking about philanthropy, if you don't mind. $50 million over 5 years.
Sure. So we have a kind of a two-part philanthropic commitment. $25 million of it was made at the announcement of our merger. And then the other additional $25 million was made during the agreement. So I want to be really clear about that. The first $25 million is over a 10-year period and was put in place to ensure that we continue to support any of the original philanthropic agreements that First Merit had made. So it was a 10-year commitment to all prior arrangements or commitments. And then we have $25 million for our current agreement. We tie our philanthropic very closely to our community development lending and investing. And for us, each one of those things we review in trying to really decide what's the ultimate outcome of any of those requests, whether it's community development loan or investment request or a philanthropic request. And work very closely with each of those partners to make certain that that philanthropic giving reaches the goal that's expected. So it could be that someone says we need X number of dollars, but they don't have the right partners or right structure in place. So part of what we will do is help identify how do we put partners together, how do we bring all the right people to the table to make certain that that giving gives exponentially. So that's really our focus. Again, we have community development relationship managers. We have 14 of them, one for every one of our regions, and they work hand in hand in our front line with our community partners. So that's our process.
Thank you. Stephanie, $93 million over 5 years.
Yes, so short and sweet, 60% of all of our corporate giving is CRA. That's a change for us. We made sure that we set that target. And so all of our corporate giving, 60% of that will be CRA qualified. In addition to that, we created what we're calling our Strengthening Our Communities Fund that just in 2017 will deploy $2.5 million additional dollars with a specific focus around affordable housing, also around small business, and also financial stability, specifically VITA, workforce development, and financial education. So, and within our overall corporate giving, beyond the Strengthening Our Communities Fund, in our overall corporate giving, we have a big focus around making sure that we're targeting our efforts in those core same areas as well. So that is how we're going to hit our commitment.
Thank you very much. Bruce, $175 million over 5 years.
$175 million is really going to be focused in 4 categories. The first is the completion agenda. We're very focused on ensuring that whether it is secondary, post-secondary, job training, some completion is critical. So too often we fund collectively programs that don't lead to completion of some kind of a degree or some kind of a certification. So that's one of the more significant investments that we will in fact make. The second is then workforce. We focus on those programs that create not just livable wage jobs, but sustaining jobs. And the first two are related. When you talk about education and training, and then you can really talk about then workforce. The third area of focus is what we call neighbors. Neighbors is really about creating sustainable neighborhoods, creating sustainable jobs within neighborhoods with small business. It is also about trying to ensure that the kind of technical assistance is available for people to create their, the kind of sustainability they need, whether it's in housing or whether it's in small business. And the fourth area is service. Services continues to be a major focus for our company. As an example, one of the things that we do, every person who serves on a board, we will provide a $500 grant to that board to support that person's service on a board. And so those are the four. Given our time, I'll cut it off there.
Thanks, Bruce. And so a lot of talk has been, I think Mark brought it up in terms of applying online and fintech and things along those lines. There's a lot of concern about branches, branch openings, closings, the change of branches to more kiosk kind of aspects. Could you briefly describe your movement forward and also how the CBA agreements impact your branch strategy? So if we could start with Stephanie.
Great. The branch distribution channel is definitely still a strong component of how we go to market as a bank. And so as a part of the CBA agreements, we committed to opening 10 additional banking centers in low and moderate income tracts as well as high minority tracts. And so 3 of those have been opened already. One actually is going to be in Northeast Ohio. We haven't set location in all of those. We still have to work through details, but definitely the CBAs contribute to our continued focus around branch distribution, specifically in low and moderate income census tracts. What I also mentioned is one additional way that we make sure that we're providing services in our communities is through our financial empowerment mobile. We take that mobile to throughout our entire corporate footprint directly into low and moderate income communities in partnerships with nonprofit community-based organizations to provide free credit reports. And many people in the room, Pat Ramsey runs that bus for the Northeast Ohio market. But we provide free credit reports. We provide one-on-one counseling. We do foreclosure prevention on the bus. And we also have the ability to open up accounts and additional services through that venue. And so we use that as another delivery model specifically targeted to our low and moderate income communities. So definitely very important for us to make sure that we're located in LMI markets.
Thank you. Bruce? Branch strategy, location?
So we have made, as a part of our commitment to the CBP, is we will maintain 25 to 27% of our branches across our footprint in LMI communities. And so that is the target we focus on. The way in which we address that issue is that we have a branch optimization team. I'm a voting member of that team, so oftentimes what happens in institutions, the retail team goes off and decides this is what they would like to do, then they come to the community folks and ask for their opinion. I will tell you, that's an uncomfortable place to be, to then say no. You would much rather be on the front end and be part of the dialogue, and so we made that switch 4 years ago, and our parity has improved. Even though we have in fact closed branches over that time frame. So our view is that branches are critical, but the other element to us is technology is an important way that people are choosing to do their banking. If you look at any data that talks about branch transactions, we have more today, more mobile transactions than we have branch transactions. And that's going to continue to be the case. And so the question is, how do you balance having physical locations, which you absolutely have to have, because when people need a branch or have a problem, they want to go to a branch. They want to, my wife goes into a branch, she does everything else electronically. Why does she go to a branch? If there is a problem, she wants to know who she's going to go talk to. And so branches continue to give advice and counsel, but technology is going to continue to be a significant element of access and distribution, and the strategy is how do you balance those two?
Stacy?
So I think for us, back to how important the community conversations were, they have completely informed where we're going to put our locations with what we committed to, which is 10 additional branches. We had identified markets where we knew as a combined organization we needed more penetration, whether it was in a high minority census tract or a low to moderate income census tract. So we've partnered in each of the communities that we had that shortfall in with not only the city and government and their planning units to try to figure out where they're going next, but to also partner with the community. And it was twofold. One, so that we could understand where they felt it was most important to place the location, but two, so we could also talk to them about the process of creating a sustainable branch. What does it take for us to put bricks and mortar in a location and have that location to continue to sustain itself? So I think with that partnership and those conversations, we've come up with some really great locations that we feel will be successful in the future. So of our 10 locations, we will have half of them opened in our first year. We'll have 4 more open in 2018, and then because of a combined decision with the community and the city of a placement in our Toledo location, that will not happen until 2019.
Okay, thank you. And so I'd like to jump into questions that have been submitted because we've got some overarching themes that are happening. And so, Stephanie, you talked a little bit about your no minimum down or your no minimum loan from that aspect, but can the others talk about there's a lot of concern about $50,000, less than $50,000 loans or small dollar lending, and it's hard to believe that $50,000 is considered small dollar lending. But then also, as you look to put these products out, how will you make sure that you're not picking and choosing winners versus losers? And so if there's a community that has much more amenities and it's easier to lend to, how are you going to pull up those other communities? I'm going to wrap one more thing in there in terms of the small dollar investing is how do we make sure that outside investors aren't coming in, picking up those properties who have cash on hand and for you, the institutions, to be able to make those dollars available. So it's really still talking about that 50,000. How do we keep cash investors from buying up our properties and renting them from that perspective? And we'll start with Bruce, if you don't mind.
No, not a
We'll just go right down the line so
Yeah, not a
everybody knows
problem.
that they're coming.
So everybody, I think, struggles with this notion of a loan that's less than $50,000 being unprofitable. The reality is it is unprofitable. The real question is the cost of originating, servicing, and managing a loan of that size is not profitable. So the real question is, how do you, in fact, give access to those kinds of opportunities? And the reality is you have to leverage partnerships. You have to leverage other tools that are in the marketplace. And so actually we are working on what we think is a fairly innovative way to provide that kind of access throughout our footprint. And it's too early for me to announce it because there's an organization who I think it would be premature to do that. But we're very interested in an innovative way to provide not only access, but to provide quality. And our view is that is a reasonable way for us to address that particular issue.
Thank you. Stacy?
Sure. I think whoever figures out how to keep the cash investors out of our communities as the primary person buying those properties is going to win a Nobel Prize, right?
That's a
Because
policy
everyone
issue.
is trying to figure out how we do that.
That's a policy
So
issue.
I will just leave that one there. As for us, for Huntington, for more than 10 years now, we've had a no minimum loan purchase mortgage. We have no closing costs. We have no PMI. So we have always felt it's a really great product. And so I think what we're going to try to do more and more is really make certain we are partnering with organizations that can help us really get that program and product out there so it can be used by all the right people. And as Bruce said, it is not profitable and it never will be profitable. But for us, it is the right thing to do. It is the way that we make our communities stable and sustaining. And then in turn, it gives everyone an opportunity to grow. And so for us, it's just the right thing to do, regardless of the profit.
And Stephanie, do you want to chime in?
I was going to say I would probably echo pretty much everything Stacy just said, so we'll leave it there.
Another question that seemed to cut across a lot of lines is, how will you report to the community your progress through the community benefits agreements? And I know that you'll be supplying some stuff or perhaps dashboards to NCRC for us to share. But in terms of reaching out the broad community, how will you do that? And also, what happens after 5 years? And so if we could wrap those two in the same in terms of how do you report, and then once you get to 5 years, what's going to happen? Does all of a sudden the spigot stop, which I'm sure it does not, but how do we move forward after that? If we start with you, Stacy.
Sure.
And then Stephanie, and then Bruce.
Okay.
Sure. So what we created, and something we had never done before, which many banks had, was a National Community Advisory Council. So our council meets 4 times a year. It has 20 members from all across our footprint. And we did that very purposefully because we wanted that ongoing communication to go back to each of our communities. So we didn't pick everyone in Columbus or everyone from Cleveland. It's really broad, and it covers everywhere from Chicago to West Virginia. So for us, when they come to the table, it's twofold. We expect them to bring us issues from their communities that we can work on as a team together, and also to take back the work that we're doing and our progress against our commitment. So that's extremely important for us. Attending that, this is kind of the funny part. I organize those meetings, so usually I'm bringing 18 to 20 community members in and trying to figure out how I get 30 Huntington colleagues into the room with everyone else. So we bring all of our senior executive leaders, we bring all the line of business leaders, our CEO. So we really work to make certain that we have all the right people at the table, so when we're having that conversation, we can take action items with this. We left our meeting on Tuesday with 10 pages of action items, of ideas that came up in a 3.5-hour meeting. So it's really just that ongoing meeting with them. We meet 4 times a year, and then we have individual sessions in between.
Okay. And after 5 years?
And after 5 years, again, we started out, we have a plan every single year. So for 19 years that I've been at Huntington, we've always had a plan. So for us, the community conversations really just pushed us to stretch our goals, right? So that's not going to change. We'll continue to have the plan and continue to grow that
Okay.
moving
Stephanie?
forward.
So we, like Huntington, also have a National Community Advisory Forum. This is new for us as well. We did not have a national forum across our corporation. We meet 3 times a year, very similar to Huntington, made up from community-based organizations across our entire footprint. And so we have those meetings, but in addition to the National Community Advisory Forum, we have statewide community advisory forums. We have one in the state of Ohio. We have representation from community-based organizations across the state. Lou happens to serve on our state community advisory forum. Those meetings twice per year. In addition to that, we have what we call our Strengthening Our Communities meeting, which are very local specific, where we actually report out on how we're doing from a commitment perspective, celebrate some successes. Pat just had her meeting in Northeast Ohio last week, and throughout the state of Ohio, we're having our local Strengthening Our Communities meetings throughout the course of the next 2 weeks. But we have those throughout our corporate footprint, and they're actually more local specific to each individual market. So that's how we're sharing the information. But beyond that, we do a community-wide report. We actually had done it historically just once a year around commitment progress, but we actually, starting in 2018, will be doing a community report around our commitment progress twice per year, and then we're going to also start doing a newsletter around that starting in 2018, twice per year as well.
Great. Bruce?
Yes, we have both a national and we have local advisory councils. We meet on a regular basis, 2 to 3 times a year. We have a corporate responsibility report, which we do annually, and within the context of the corporate responsibility report, there will be coming up this year a focus on our community benefits plan. And so we will engage with the community on a regular basis. Those meetings are very specific and intentional about what the plan is, where is our progress, and then ultimately looking for both advice, counsel, and input on a go-forward basis.
Great, thank you. And Barbara, you've been sitting here listening, and so I'm going to give you the last 60 seconds. 30 seconds? 15 seconds? Before we give claps and kudos to everybody here. But, you know, you've been sitting here listening patiently. And
Waiting my turn.
waiting your turn.
And so,
And
well, there's two things.
let's
I
wrap
really-
us up.
I really wanted to say, first of all, I wanted to thank NCRC for Lou Tisler both being here. Anybody who's here in the audience knows of his good work and all that he's done.
Oh, especially if you're talking about me,
keep
use the
doing
mic. Jeez.
I wanted to thank NCRC for allowing Lou Tisler to be here with us, but also the fact that he is at our regular board meetings for GCRC, always bringing us information of what NCRC is doing, keeping us abreast, and also taking back information from GCRC to NCRC, to the national, taking it from the local to the national and bringing it from the national to the local. So that has been very beneficial. But yes, I have been sitting here and listening. And in listening, I've been a little selfish because I've been thinking about all the ways that GCRC could assist and be a part in what all three of the banks are doing. As I said before, there's over 60 organizations. We're all invested in our community. We all are already on the ground working with the people that you're talking about right now. And we certainly are open to partnering in any way to help continue the good work of the banks and for our communities. So we really would love to hear from you. Give us a call. We'll certainly be calling you, talking about the different things that we feel that we could do and assist the banks in meeting their goals and assist our communities in taking advantage of every opportunity to do that. So thank you very much for your being here today. I know it took time out of your day, your work day, but I'm so glad that you're able to be here and just kind of let the community know what it is that you do and what that mystery CBA is all about.
Thank
Okay.
you.
Thank you.
Yeah.
And if we could give the panel a round of applause. Thank you.